Okay, so far so good. What we've tried to achieve so far is we've talked about what share-based payment is. So we've also discussed the terminologies, and let me just remind us. So we've talked about the grant date, the date the arrangement and the agreement is done, where we know the number of employees, the fair value. That date, there will be a fair value. We also determine the, what do you call it? The number of years in terms of the service condition. We also learned about the vesting date, the date the employees become entitled to the share-based payment. We also talked about the exercise date, the date the employee actually receives the share-based payment. So these are, and we talked about the vesting period, the period between the grant date and the vesting date. All right. So these are the key terminologies we discussed. And we talked about the fair value. The fair value, we said that if it is equity settled share-based payment, you use the fair value at the grant date and it never change. It's always what you'll be using all the time. Okay, so that is what we said. But if it is a cash settled equity share-based payment, cash settled share-based payment, then you are going to apply the fair value as at each and every reporting date. All right, so that is what we discussed. And yesterday, we tried to deal with the accounting after the vesting date. And that is where we spent a lot of time. So accounting at the vesting date, we said that all that we said is that no further adjustment is made to the total equity. And this applies to the equity instruments that do not vest because the market-based conditions were not met. Because what do we call it? We talked about, I think I discussed performance conditions. Yeah, I've omitted that one. Performance conditions. And the performance condition, we talked about market-based conditions, which is connected to the share price. And we talk about non-market-based condition. And we said that the market-based condition is about the share price. The non-market-based condition is about any other thing other than the share price. Example is the earnings per share and the profitability you expect the company to get. And we said that when it is a market-based condition, it is assumed that that condition is embedded in the fair value. And so therefore, the condition of the market doesn't really change anything. In fact, what we are trying to say is that if it is a market-based condition, then assume that there is no condition at all, because any changes, fluctuations in the fair value or the share price is already assumed to be taken care of at the fair value at grant date. So you assume that nothing is even there at all. But the non-market-based condition has an influence in whether the shares will vest or employees will vest, or the employees cannot vest the share-based payment. And so if it is a non-market-based, if those conditions are not fulfilled, then it means that you cannot even vest. All right, so that is what we said. Then back to the accounting after the vesting date. So we said that even if the market conditions are met or not, there is no further adjustment made on the total equity. And we said that what will happen is that the entity may transfer any balance from the OCE of the equity to the retained earnings. But the key thing I wanted you guys to understand is that what we've been doing, you see, when we do when you are doing the share-based payment in the vesting period, it is all about estimates. It is not an actual thing that is happening. You are making estimates. That is why we use the number of employees who are, best estimate of number of employees who are expected to vest. It's a provision. All right. It's a provision. And let me also reiterate this. When we talk about equity settled share-based payment, okay, and we use example as options. When we talk about options, option is something that is granted to you. All right. Now you have the word option means choice. You have the choice to exercise it or not to exercise it. That is why we call it options. So if at the time we say you have to pay us 2 cedis for a share, you can exercise your options to buy from the company a share at 2 cedis. It will depend on the market value of shares as at the time you are expected to exercise that choice. Now, you and I know that you are in the business to make profit. And so therefore, if at the time you need to exercise this option, the share price is say 5, you will be quick to exercise. Why? Because you are buying something at 2 for which the actual selling price on the market is 5. Meaning that when you exercise, and what we mean by exercising means that you buy the shares at 2, you can sell the shares in the market at 5 cedis and get a profit of 3 cedis. Now, this is what we encountered in the question where we were trying to deal with. Now, if the share price as at your exercise date is 1, then it means that if you buy these shares by exercising your option at 2, you will be selling it. The value of the share is 1, which means that you've overbought the thing at its price. So it is not reasonable for you to exercise this option. You will allow the option to pass by. That is why we say allowing the option to lapse. Okay, if you now exercise this option, it means that you are going to buy the shares of the company at 2 cedis. The question is, what is the value of the share of the company itself? If the value, the nominal value or the face value of the shares of the company is 1 cedi, and you buy the shares at 2 cedis, it means that the company will record a stated capital at 1 and a share premium of the additional 1 on top of these 2 cedis. That is what we mean by that. Now, if you now exercise, it means that you are vesting your share-based payment. You are buying it, and such that each time the company is making a payment on shares, you will be receiving some monies because you also own a share in the company. As at the time you are drafting the thing at the grant date, you don't own anything in the company because there is a condition as attached to it that you have to be there for, let's say, 3 years. So until the 3 years come, for you to actually have the equity instrument, you don't own anything. So between the 1 year to the 3 year, anything that happens between is an estimation. And you see, if you become an owner of the company, then it means you have to buy share. What is a share? A share is the unit of equity ownership into an entity. So if you don't have a share, you don't own part of the company. How will you have a share? You will have a share if you exercise the options that has been given you, if you stay there up to the 3 years. So you see, before we get to the 3 years, all that thing we do and put at the other component equity as part of, as an element of equity, is an estimation of how much we think people will come into the stated capital with. It's an estimation. And that is why we estimate the number of employees who will be there to actually vest their options. Because if you will not be there, then we need to take you out. That is why we are using best estimate. Now, if you get to the vesting date and, okay, we have 9 million shares, which we are expecting people to actually exercise their option on. If we get there and 7 million people do it, then it means that, Esther, just a minute, then it means that what is going to happen is that there is a difference of the estimate that you did and the actualities that are happening. And therefore, you may transfer that difference to retain earnings if you want, or if anything, you will leave it at the OC. Okay, so Esther, let me hear from you, your question.
Thomas, please,
Yes.
can you use a black way, a black pen or something? Yeah, is my eyes? It's difficult to see.
Sorry. All right. So please, that is what the whole share-based payment thing is about. We are giving you an option so that at the time when you have served for the service condition, you can exercise and become part of the equity ownership of the company. So that is it. So that when we declare dividend, instead of giving you a bonus directly, you become part of the ownership. And therefore, when we declare dividends, you will be getting some. That is how share-based payment concept is about. So we said that accounting at the vesting date, the only thing that will affect your accounting treatment is the non-market-based conditions. Because you know what? If the share price of the thing is 5 cedis and the company is going to sell it to you at 2 cedis, it means that the company is going to bear the difference of the loss, which is 3 cedis. And so a non-market-based condition like, oh, the profitability of the company must hit a certain level. Why? Because they are going to pay the difference of the 3 with their own money. So if the non-market-based condition like profitability is not met, they cannot allow you to exercise the thing at 2 for them to bear the 3. That is why if the non-market-based condition is not met, it is a problem. But if it is a market-based condition, that one, regardless of whether it is met or not, it is assumed that any change is embedded in the fair value. So that is all that we are talking about. And so we try to deal with an example. We try to deal with an example. And let me bring it up. I think it was a question 3. Question 3. So this is what happened. So the question told us that beginner offered directors an option scheme conditional on a 3-year service. So this is the service condition. So it means you have to be there for 3 years to be able to earn your way into an equity. It was an option. The number of options granted to each of the 10 employees at the inception was 1 million. So it means that if all the 10 shareholders are going to vest, you multiply 10 directors by 1 million, which will get you how much? 10 million. The options were exercisable, and this is a key thing you have to note in the question. Exercisable shortly after the end of the 3rd year. So it means that the vesting date is the 3rd year. The 3rd year. But they are exercising it shortly after the 3rd year. And so what we are looking at is what we call accounting after the vesting date. Accounting after the vesting date. That is what we are looking at. So you could see that they exercised it shortly after the 3rd year, but the vesting date is the end of the 3rd year. Okay. Upon exercise of the share options, those directors eligible, so upon exercise of the share options, those directors eligible would be required to pay 2 cedis of each share, and by that share, its value in the company is 1 cedi nominal. The fair value of the options and the estimate of the number of options expected to vest at this various points is what you see. So at the beginning, we have 8 million at 3 cedis. At the beginning of the year is when they are doing the grant thing. So the grant date is here. And so the fair value you need at grant date, this is it. These are fair value at reporting days, as you can see, the end of year 1, end of year 2. If you make a mistake and go and pick these things as your fair value, my question to you will now be, at the end of the 3rd year, what will be your price? So that is something you need to check. All right. So always look for the grant date, since it's an equity-based settled share-based payment. All right. Okay. Now, we moved on to requirements of the question. The requirement says that we should show how the option will affect the financial statement for each of the 3 years. And we did that perfectly. So year 1, we need if any number of people left or anything, which good for us. Those things were done for us in this question, because the whole thing started with 10 million people. And you could see that at the end of year 1, 10 million shares, all right, has come to 7 million, telling us that probably 3 of the directors had left. So these were our requirements of the question. So perfectly, it was so easy for us to just pick. So let's put equity here. And the equity is the OCE. All right. Then let's put expense here. So it was easy for us to now say that, okay, we will have 7 million. Where is our fair value? Fair value is what? 0.3. Now, the fair value, if you remember when we started, we said that within the vesting period, the fair value is spread over to the vesting date. And that is why we always do, for example, if it is 3 years, 1/3. Please, you have the figures, so you can just give me the figures. Let's slot it in. All right.
$700.
It was 700. Okay, so we had 700. Next year, so 700, 700. Then we come to year 2. RA, please kindly mute yourself. Then we have year 2. We have 8 million people, 8 million, right? 0.3 or by 2/3. And how much was that? Then year 3. Please help us with the figures. Year 3, we had 9 million. This is what they said at the end of the year 3. 9 million rights actually vested. So you have 9 million multiplied by 0.3 cedis, then 3/3. All right, please, fast.
1,006 for the year 2.
1,600.
1,600, meaning here will be how much?
900.
900.
And I think this one was 2,700.
2,700.
Please don't forget the thing is in millions, so you have to put 3 zeros. All right. and this side was 1.1.
1,001.
All right. So this part we have done answers the A part of the question. And so all you need to do when you are done, rearrange it well and say staff cost, P&L. These are P&L items. All right. And these are SOFP items. You just do that. I think this one is not a problem for you. Then we came to the B part of the question that says that the fair value of the shares was 5 and all eligible directors exercised the option. Good for us. So in any case, if we are answering the B part, if all of them exercise their options, then it means that they exercise it at the price. And this is the price. They exercise it at 2 cedis. And so if they exercise, the company for which we are recording the transactions for will debit cash that they are receiving. They are receiving a cash of, we have 9 million shares priced at 2, which they are paying, and therefore we will have what? 18 million. That is what we have. Okay. In any case, we should not forget that we already have this amount in our OCE. This amount that you see here is an amount that has been provided in our OCE, which they are buying it into what we call stated capital. This one is seated in our OCE and not in our stated capital. So what will happen is that now that they are exercising the options, we are getting the real transitioning from OCEs into stated capital, because now they are buying. The 9 million shares are being bought at 2 cedis to take the position they are in from an OCE level, which is, although is equity, into a stated capital, because they are buying their way in it. All right. So now, what is going to happen is that if that is the case, then we need to reverse off this 2,700 from our equity. And when I say the equity, what I mean is the OCE. So we will reverse our 2.7. And this thing that they did, the cash that has come in, is a credit. The corresponding entry is a credit, stated capital. But because it is over the nominal, we will record both stated capital and a share premium. And so the stated capital aspect will be the normal 9 million that is coming in, multiplied by the nominal value, which is 9 million. Of course, you can just stand here and say the differences between this one and the 9 million that you have going to your what? Share premium. When you add this side, I think the difference will be 11.7. 0.7 million. So that is what, and it's a, here you see it as a balancing figure that is going to your share premium. The share premium herein is, what do we call it? The figure of 9 million, these two, the balance of the one. You see, we used one. The balance of the one is what we are saying will be going into your share premium, and therefore you balance this thing of having 20.7 million here. Somebody can also sit down and say, okay, we already credited OCE with 2.7. And so, and there has been an exercise of the shares at 2. All right, 2. So what you will do is that cash is coming in to the company. So therefore, we will debit cash of 18 million. Of course, assuming that you don't have much knowledge about share premium, you already know that your stated capital, but this is a professional class, so let's do the right thing. Your 80 million corresponding entry here will be split into stated capital of 9 million. Please, this thing should be 7. It should be 2.7. Okay, per what we are doing, since we are expressing them in millions. So it will be 2.7 million. Then we have this one to be 9 million. 9 million. The stated capital, 9 million. With our share premium, 9 million. So therefore, if we are now reversing this thing, we will now debit our, what do you call it, our OCE with this figure, 2.7. Are you getting it? So that it cancels this one off. But when you cancel it off, it balances. You have the same thing here. All right. So that is what we are trying to do. But you see, it is an accounting. And if you are doing accounting and this one was already there. So now that you are debiting this one, the corresponding entry is the one that we call share premium also. Because if this one cancels this, so the corresponding entry is the share premium. So if this one is off, then it means that you still come back to what we have. But if you put this one here with nothing here, then you still have your 20.7. You add this side up, you have your 20.7. All right, so that is what we did. But this seemed the correct passing of the transaction. So what we are saying is that since they all exercised it, there is nothing to do. They've exercised it, you pass this correct transaction, BI, you are done. So that is the ultimate. But in the BII, the question says something interesting. It says that because the share price as at the exercise time was 1.5, then all of them did not exercise it. They allowed it to lapse. So if they allowed it to lapse, it means that we are still at the same point. Nothing of this sort has happened. That is the BII part. Nothing of this sort has happened. This one, it will not be there. We are still at this place. And you see, this figure will continue to be there if you want. But if the thing is not exercised and you want to take away the OCE element, transfer it, you may transfer it to your retained earnings, and therefore you will what? Debit this OCE account and now transfer this 2.7 to retained earnings. It is an optional. It is an accounting policy. If they do it, then you do that transaction for them. If they don't, then there is nothing for you to. All right, so that is that. So already this one is in OCE. By we doing this, you see, this one is a credit seated in the OCE. We doing this will actually net off this side, because what we're trying to say is that this one that is there is in the equity. We are taking it off the equity. But that equity where it is not a stated capital equity. It is embedded in here. All right. So that is what we are saying. So it is a may, but when they all exercise, this is how you pass your transaction. If some of them exercised and some of them did not exercise, then the sum that exercised, somebody asked, okay, so if let's say 7 million out of the 9, 7 only exercised, then we are going to do 7 million multiplied by our 2 to get 14. That is what we are going to do. Then if only 7 did, then in this 2.7, we are going to do the 7 out of this 2.7, which when you do will give you 2.1. So it is the 2.1 that we will debit with our equity. Then our stated capital will be 7 by 1, which is 14. Which is 7. Then share premium of 7 by 1. So when we do this, we will have 16.1, and the balancing figure thereof will be what? 9.1, if I'm not wrong, which will be here. Yes, so that we get 16. So the difference of 2.7, out of which we've done 2.1, there is a 600 that is still seated inside the OCE here. There's a 600 that is seated there, a 0.6 million. That 600 is, in this case, what we say, you may move it from the OCE to retained earnings. You may, supposedly, if it is the policy of the company. That is all about accounting at the vesting date. So accounting at the vesting date, after the vesting date, is just saying that the entity may transfer any balance that is in the OCE. You see, this is the balance that is the OCE. If nobody exercised their option, this is the balance. This balance can be transferred to retained earnings. If some exercise, this will be the balance. Okay, this will be the balance. In that case, this balance may go to the retained earnings. But if all of them exercise, then this is what we have. All right, because the thing is being moved from the OCE. So we are debiting this thing to move the figure from the OCE and add it to our capital. All right. And by crediting our capital, because it is not a purchase into capital, it is going into what? A share premium. That is all that we are saying. So you see, the share premium that we have here is a combination of the 9 million and the 2.7 we have moved from the OCE into share premium. That is all that we said. That is all what accounting after the vesting date is about. You see, the debit of this one we have done, it means we are moving the money somewhere, because this is where it is. This is where it is. So if we move it from here, we are just going to put it somewhere else by changing the name. So we are debiting the OCE to take it off and putting that same figure in our equity structure share premium. So the share premium, which is there, see, this one was 2. The balance of 1 share premium and what we have removed from the OCE put together to the share premium. So that is all that we are saying. That is all that we are saying. Please, any question at this point? Any question at this point? All right. So if there is no question, we move on to the next phase of what we call modification. Modification. I instructed that people read on share premium, stated capital, share dues, treasury shares. Is there anybody that did that? Is there anybody that, if you did, kindly give me a hand? All right. So now we move on to modification. Okay, so under modification, what we are trying to say is that, you see, at the grant date, what we do is the agreement. There's an agreement. That is what happens. So, and that is the agreement that we go by. But you see, for those of us, we are Ghanaians, there's something that says that there's a proverb. I've forgotten how they say it in English. In Chi, they said that when things change, you have to change along with it. And so all the agreements that you've done at the grant date, there can be another agreement towards those agreements you made at the grant date. So when we talk about modification, what that we are trying to say is that modification is the altering, changing, all right, when you alter the terms of the terms of agreement. So the terms and conditions of the share-based payment scheme or the share option scheme. So when you make changes, all right, during the vesting period, because you can't make the changes after the vesting period or the vesting date, because that date, the person is already entitled to it. So you can make the changes prior to that. So when you make any changes to the vesting period, then during the vesting period, then what do we do in accounting? Of course, people change. You see, I gave you an example that you realize that at the during the last date, the vesting date, or the date for people to exercise the thing, the price at one point was 5. Sorry, the price was 5 in the question, and at some point the price was what? 1.5, and the thing was to be exercised at 2. So you see, the reason why they author the thing is to increase. The reason for modification is actually to increase or decrease, or to decrease the scheme, just the exercise price that you have in the scheme. All right, so this exercise price, you see, at this point, if somebody exercises this thing when the market price is at this 1.5, the person is making a loss. And so they increase or decrease the exercise price of the option. So like this one, they know that, oh, okay, since the market value is just 1.5, let's now decrease our exercise price to 1 so that it will be favorable. So with the aim of making the thing favorable. Or less favorable. So for example, when this thing is at 5 and you increase the exercise price to 6, you are making it less favorable for people to exercise when the price is what? At 5. So that is what is happening. So that is all about modification. Okay. So what we are saying is that change in the vesting conditions to make it more likely or less likely for the people to vest it. All right. So that is all that we mean. So one is change in the exercise price. The other, we are talking about change in the vesting conditions. So vesting condition, for example, you originally said that people should be there for 3 years. Now you change the conditions to 4 years. All right. So another one will be change in vesting conditions. To make it more favorable. Or less favorable. So initially it was 3 years. You want to change the condition, the service condition, to 4 years. I mean, my Jumano, I've been there for 3 years. So why do you need to change it? But it's a modification. And so what do we do in the modification situation? If there is a modification, what do we do? There are three things or three steps or three things I'm going to show you to do in any question that there is a modification. The accounting treatment of an equity settled share-based payment. So upon modification, and don't forget, we are dealing with equity settled share-based payments. For modification 1, and these are the things that we are going to apply in the question. So I want you guys to pay more attention to that. Upon modification, what you do is that, 1, you have to continue recognizing your fair value at grant date. Continue with that. Of the equity instrument. The one that you've known to do, what we've been doing, continue to do that. All right, in your SPL and your SOFP. Now, unless you will stop continuing this, unless, like I said, when we're doing the market, the performance condition, unless there is a non-market based condition that is not met. Please take note of that. Take note of that. Unless there is, or the instrument, the equity instrument, do not vest because of failure of the non-market based condition. Please, the non-market based conditions, if they are not met, no matter what, the shares cannot vest. All right, the options cannot vest. So non-market based condition. So in the exams, be very, very careful the conditions they attach to the question. If it is a non-market based one, I have shown you that to every share-based payment, there are 2 conditions. 1 is the service condition. 2 is the performance condition. The performance condition is subcategorized into market-based and non-market based. All right. So please don't make a mistake going to use the service condition as a performance condition, a non-market based condition. Don't make that mistake. So you go ahead and do what you do as usual. So you take the number of employees, multiply by the number of options, fair value, then you amortize the fair value over the number of period to vest. All right. So that is what you do. Then the modification part, that small part of the modification. If the modification increases the value, if the modification increases the fair value, then what do? The extra that is on top, the extra. So not all of them, because you've already considered what you had to do using the fair value at the grant date. So the extra that you have is expensed in the P&L. So extra expense must be recognized. When we start with the figures, you appreciate all these things we are preaching. So what we are talking about is that we will need, in terms of calculating the extra, you will need the fair value of the new arrangement. Fair value of the new arrangement. Of new arrangement. Or new agreement. All right. Fair value of the new agreement, which you see in the question. Then you will subtract the fair value of the old arrangement or agreement. All right, so that is that. And these fair values are usually the fair value immediately before the new arrangement. All right, so it has been modified. The freshest modification, all right, upon the new, the old one is what we are talking about. So this one will give you what we call the incremental fair value. Incremental fair value. Now, when you now get the incremental fair value, then you go ahead and spread this incremental fair value. All right, so let me make it 0.3. The extra we are talking about here, which is by virtue of the incremental fair value. So let me say the extra expense is also spread over, is also spread over the period. The period. And the period I'm talking about is from the modification date, from the modification date, the day they did the modification, to the vesting date. So if the vesting date is in 3 years' time, and they did the modification in year 2, if they did the modification in year 2 for an incremental value of say 5, then that 5, you are going to multiply it. If you are in year 2, you are going to multiply it by what? 1/2. So it is from the time of modification to the vesting date. All right. So from the time of, if the modification happens in year 2 or the very end day of year 1, then it means it starts 2 years. So from year 2, you amortize the value, the incremental fair value, 1/2. So year 3 will be the same 5 over what? Another 1/2, the remaining half. So that is how it will be. So you spread it half for year 2, half for year what? 3. All right. So that is what we are talking about. If the modification happened in the first year, then it means it will be 1/3. You spread it 1/3, second year, 1/3. So that together will all be what? 3/3. So you spread the incremental over the time from modification to the vesting date. So that is all you need to know about modification. To express this, then we need to solve a question. But if there is any question you want to ask so that we can move on to use a question to explain what we are talking about. Yes, any question? Any question? All right. So in the absence of any question, let's look at a question. So we're going to take the next question. We're going to take the next question. I think question 4 will help us achieve what we want. All right, so we have a question ahead of us. So the question reads, that an entity grants 100 share options to each of its 500 employees, provided that they remain in service for the next 3 years. So that's the service condition. The fair value of each option is 20. All right. Now I'm going to ask questions. So, Bubu, you are the first person of contact. What fair value is this?
Sir, grant date.
Grant date. Thank you. So you note it down. Now it says that during the year, 50 employees leave. During year 1, 50 employees leave. Then the entity estimate that a further 60 employees will leave during the years 2 and 3. At the end of year 1, the entity reprices. So this one is the modification. 8 share options because the share price had fallen. So they repriced this one, this 20, at the end of year 1, the very end of year 1. They repriced this one. And it says that the other vesting conditions remain the same. So the vesting condition of you staying for 3 years was the same. At the date of repricing, the fair value of each option, of each of the original option granted, before taking into account the repricing, was what? 10. The fair value at each repriced of each repriced share is 15. Okay. So this is the repriced. Okay. This is the repriced. So it is repriced to 15. During year 2, a further 30 employees leave. And the entity estimates a further 30 employees will leave during year 3. During year 3, a further 30 employees leave. Calculate the amount to be recognized in the financial statement for each of the 3 years of the scheme. So that is our question. But indeed, there was a modification. What do we do when there is a modification? So now, we look at year 1. The modification effect happened at the end of year 1. At the end of year 1. So the effect of the modification will take place from year 2 onwards. All right. So kindly take note of that. I'm going to ask you to give me the number of employees who will vest. So what we normally do, the number of employees we are estimating to vest, and you give me the number of options, then the pricing. So somebody is going to do, so let me put here equity, which is the OCE. Then let me put here the expense. So I'm going to call Adamu Bintu Fati. Please give me the figures for equity and the figures for expense. Yes. So what is the number? Give us. Hello, Fati. Oh, you've muted.
I'm not working.
Oh no, they help us. You give us the figure. We all work it together over here. Just guide us.
Okay. We have 100 shares.
Yes, I've seen the 100 options.
100 options times 500 employees.
Times 500 employees.
Times the fair value of 20 cedis. Times 1/3.
Okay. Is that all?
Yes, please.
All right. And I'm going to call on Elikem. So Elikem, also give us your thoughts.
Hello?
Yes, I'm listening.
So for year one, it's going to be 500, that's the employees, times 100, times 20, and times
So minus 50.
Please come in. Who is talking now?
So I want to make the correction.
Oh, okay, that is Bintu.
Yes, please. 500 employees minus 50.
Okay.
Minus 60.
Okay.
Times 100.
Okay.
Times 20. Times 1/3.
All right. Elikem, would you like to complete yours?
I wanted to add the second paragraph. During the year one, 50 left and an additional. So I wanted to add that one too.
Oh, so add. Whatever you want to do, just do.
Okay. 500 times 100 times 20 into brackets. So before the bracket minus.
Before the bracket.
Yes. 500.
Before the bracket.
Let's start all over. 500 times 100.
This is it.
Times 20. So minus into bracket. 50 plus 60. You close the bracket, yes.
All right.
Then 1/3.
And 1/3.
Yes,
Somebody said it's the same thing. Okay, so do it and see if you get the same answer. Is it the same thing? Is it the same thing?
No.
It's never the same thing.
Yes. The second one is the correct one. 500 minus 50 minus 60 times, yes.
So 500 minus 50. So Elikem, I don't know if you were with us from the beginning. So by 20, so 100 options by 20, which is the fair value, multiplied by what? 1/3. And what do you get? What do you get?
260,000.
260,000. So since it's the first year, we have 260,000. Please, you have to be confirming. Then we come to year two. All right. So year two, when we were doing the modification, we said that when there is a modification, what you do is that continue to exercise the fair value at the grant date. And when you finish, look at the extra expense to recognize which if the modification is an increase in the fair value, that the repricing, it was an increase in the fair value. If it was an increase in the fair value, then it means that you do the differential again and add. All right. So now, let's look at year two. So year two calculation without the modification. Let's first look at without the modification. Hamdia Suleimana, can you help us? Can you help us? Hamdia Suleimana. Okay, Hamdia doesn't want to talk. Christabel. Or Hamdia is back. Hamdia is not back. So Christabel. Christabel. Yes, Christabel. So Christabel doesn't want to talk. Stephanie. Or you people have joined the Zoom and you are watching, what do they call it? That thing they call it, date rush. Date rush.
It's not time for this rush yet.
Hey, I see. So you are a regular customer. That's the meaning. All right, Fred Tete. Fred Tete. Hey, you people are not minding me.
Come on.
Yeah, Stephanie, let me hear from you.
No, make him.
Yeah, 2, please.
Okay. 500
500
minus 50.
minus 50
Yes. Minus 30.
minus 30.
Yes.
Is that all?
Minus 30.
Minus another 30.
Yes, please.
Is that all?
Yes.
Okay. All right, I have a message in the Dropbox. Okay, so that was Elikem. 500 minus 50 minus 60 minus 30. Did you agree with Elikem?
No, please.
No, please.
All right.
No.
But do you agree with Stephanie?
Yes, please.
Yes,
All right.
please.
So we can go ahead and multiply by 100 options by 20
20.
by what?
2/3.
2/3. So what will we get from that? So those of you who are still struggling around this area, we've gone past. So please visit the old video and try and understand some more, right? So give me the figure.
So please, if you can just throw a little light on that for us, please.
Oh,
just
no.
a little, please.
Where we are now, there, we are long gone. So just go back and watch those videos, all right? You get it.
So 520.
It's 520.
Yes, please.
Please confirm. Somebody should confirm too. I need all hands on. It's what?
520.
All right, so I have 2 or more. So in the testimony of 2 or 3, a matter is established. So 520. What do we have here?
260.
The expense is 260.
It's 260.
Yes.
All right. So, yes, anything?
Hello, sir.
Yes, please.
Sir, please, sorry, my internet messed me up. Has the modification begun?
No, yeah, we are now coming to implement the modification on the question.
In the year 2, okay.
Yes, in the year 2. So at the end of year 1 is when the repricing began, but it was at the end, so it doesn't affect the expense in the year 1 because it says at the end of year 1 the entity reprices the shares. All right, and the other vesting condition remain unchanged. Okay, so the modification is actually taking step in year 2. Are you getting it?
Okay.
You can't modify.
Yes, please.
Yeah, you can't modify something at the end for it to affect some from January to December. Okay, so it's starting to have its effect in the second year. So we now come to the modification.
Okay.
All right, in the second year. So what we said was that we will need so obviously these things will still be the same. All these things will be the same. So we will have, yes, I have a message in the Dropbox. Okay, who is that? Somebody has dealt with Hamdia. I have a terrible network. When I speak, you don't hear. 500 minus. Hamdia, which one are you doing? Is it the modification or because where this 5 is, I don't get it. But if it is the modification, you are so correct. So if only it's about the modification, you are so correct. All right. So you will have, but I hope you are not looking at the solution to inform me anyway, but you are doing it with understanding. Okay, modification. Thank you. So the modification, you have your 500, you have your 50, your 30, your 30. That one is not a problem. You have your 100 options. That one is the only problem. But the fair value has changed. All right. We are looking at the incremental. So I said the new arrangement minus the old. The old I'm referring to is the fair value immediately before the modification. The fair value immediately before the modification. I think I made a small note when I was doing that note side for you. Fair value immediately before the modification. So they are not modifying this figure. The thing was 10. That is why they are modifying their repricing to 15. It is 10 because if you read here, it says that at the end of the year one, the share, the entity reprices the share because the share price has fallen. It was falling to 10. And because it was 10, they now modify their own to 15. And so the new price will be 15. Then the old they are modifying will now be the 10. Please, it is not the grant one. It is not the grant one. It is the 10. The one before taking into account the reprice. If there was no 10 in this question like this, then we all know that the existing fair value there is the 20. But because the fair value here at the date of repricing, the fair value of each original share option was just before taking into account the repricing was 10. Because of that, the new is what? 15. The old, which is the one immediately before the repricing, is 10. Now, and so we will have 5. That is why so my only worry is that, did you give me 5 because you did 20 minus 15, or you gave me 5? Well, if you are giving me 20 minus 15, and well, the new would have been 15, then the old would have been 10. So it should have been negative 5. Yes, but you gave me 5. So let me believe that you did 15 minus the 10. So in your name, that is it. But remember, I also said in the point 3 of the modification that you will spread it over from the time of modification to the end of the vesting date. But you see, the modification is taking effect in year 2, and therefore it will just be, and we have just 1 year left, so it will just be 1/2. All right. So that is for the modification, like the way she did it for us. So what was your figure? What was your figure? Because the figure you have here, this is a new thing. The figure you have here is the same figure that we'll be having here, just as you did this one. All right. So yes, what is the figure?
97,500.
97,500. So 97,500. So that is what we have. I have something in the block. Okay, 97,500. So that is it. So at the end of the year 2, we will now have our figures put together. So you give me the total of year 2. Then we come to year 3. Year 3. All right. So in year 3, let's do with our normal grant date. All right. Then we do the remainder of the modification. So yes, who is helping me? Okay. So this one will be 617,500. Yes. What about the other one? All right.
357,500.
It's what?
357,500.
357,500.
Please, somebody should confirm.
All right. Then year 3. Can you go ahead and give me year 3? So we will have 500 minus the 50 that left over here. Then how many left in this?
30.
30. Then minus 30, right?
Yes, please.
All right. So 50, these people living, we don't need the estimate. Then this one, the 30 that left, all right, in year 2, then the new 30. So that is what we have. All right. So we do multiply by 100, multiply by 20, multiply by what? 3/3. So what will we have here? So get it for us. Then let's do the modification. So the modification balance to
780,000.
780.
80,000.
All right, 780,000. What will be here? So okay. So what will be here? Then so the modification, we have 50 minus 30 minus 30, multiply by 100 options, then multiply by, so here is 5. So I'm not going to do 50 minus 10 again. So 5. And the balance is what? The half, 1/2. So the half that is here. Because we were spreading it over. So if we shared whatever you had, if you shared half of it over here, then the remaining half is coming here. All right. So, but do it and get me the values, please. Of course, I think this thing is the same thing. Everything here is the same.
Yeah, the same things. 97,500.
97,500. So get me the others. So 97,500. That's it. Because you are spreading the expense over. So get the figures down. Just taking 1 minute to pick mine. So get the figures down. Once I come, I'll ask you and you slot them in, or you can drop it in the chat box for me. All right. So how much do we have for this side?
Thomas.
Yes, please.
Please, the modification for the year 3.
Yeah.
The amortization part.
Oh, to the balance sheet is for this side. This, no, it's supposed to be the full amount in the balance sheet. It's supposed to be 2. So when you do the full one, how much is it? Supposed to be 2/2, right?
Yes, please.
Yes. This is the balance sheet figure. Let's do it properly, please. is the half that is going to, in fact, multiply it by whole number 1. It's the same thing. So
Martin, are they gone?
it's 2/2. But the half will come. Okay, you give me this one first. It is in the expense that you see the other half. So give me that one first.
195,000.
195,000. So 195,000. So that, like we do, the difference between
195,000, say.
Oh, sorry.
Ma?
So like we do, the difference between this one and this one will go where? P&L, like we've been doing. So which is the 97,500, right? Then what about this side? Yes, who is giving me this side? It will be the difference between this and this. Like you've been doing, the way you brought this one here, it was the difference between this one and this one. So the same thing you do, difference between this and this. So the modification one will be the difference between this and this. This is the balance sheet figure. All right. So
260,000.
it's what?
260,000.
260,000. All right. Okay. Thank you very much, Stephanie. So now let's get the total so that we'll move on.
$975,000, sir. Are we adding?
And this side will be how much?
$357,500.
357,500. So that's that. If you finish and you want to do the P&L thing that we do, do staff cost and bring these figures. So it will be this one, and this one. Then you do the SOFP and put 260,617, then 975. All right. So I have a message in the Dropbox. Elicam, what 260 is that? All right. So I think you wanted to give us this side. All right. So that is it. That is it. So the only thing that happens
Hello, sir.
is the modification. Yes, please.
Hello, sir. Please, how do we get the 97,500?
This one? Is it this one or
The
this
next-
one?
Yes, that one. Yes, please.
Is it this one?
Yes, please.
So we took this one, like you do, you take this one, then you subtract this. When you finish computing this, so 2/2, you get 195. Then you subtract this place. Is that okay? Is that okay?
Yes, please. Thank you, sir.
All right. Thank you very much. Please, any other question? We move on to the last thing under equity settled share-based payments. The last thing under equity settled share-based. All right, so let's go to cancellation. Let's go to cancellation. Mr. Ransford, are you okay with the modification now?
Yes, sir, I'm okay. My internet is messing me up, but I'm following.
All right. So let's look at cancellation or settlement. So we've talked about modification when they modify it. All right. What about cancellation? Cancellation, we are talking, what we are saying is that the entity can decide to even cancel the share option at all before the vesting date. All right, they can decide to cancel it. You see, in the vesting date or at the vesting date, there is an entitlement. So that one, there is an obligation. Everything we do up to the vesting date is an estimate. So you see, this one is an estimate. This one is an estimate. It is the third year which we actually saw those who have left. So you realize that here only 50 left. And I think 50 left, 30 left, we made estimate of 30. So it makes everything we've done here a provision. 50 left, we made an estimate of 60 to leave for the remaining 2 years. So it makes everything we've done here a provision. But over here, we now know that 50 left in the first year, 30 left in the second year, and a further 30 has left in the third year. So the remaining are actual. So here, it is no more a provision. It is an actual thing that has happened. Only that we are waiting that they exercise the option. All right. So that is what has happened. So before the vesting date, because on the vesting date, there is a right and there is obligation. So before the vesting date, the entity may decide to cancel everything. May cancel or settle the share-based payment, the share option scheme or share-based payment. All right, they may decide to cancel it. Now, when they cancel it, what do we do as an accountant? What do you do when they've canceled it? Okay, it is at the estimate level they canceled it. It wasn't at the vesting date. So what you do is that, number one, what you do is to, all you have to do is to accelerate the vesting. All right, so if the cancellation happens before, and that is the key, before, or during the vesting period. So before the vesting date, or another English for that is during the vesting period. If cancellation or settlement happens, then what you are going to do is that you do an accelerated vesting. What do we mean by that? So you assume that everybody has vest. All right, you assume that everybody has vest. Okay, and so that therefore what you do is that you recognize the amount that would have been recognized over the vesting period all at once. All right, so recognize the amounts that would have been recognized, would have. Would have been recognized over the vesting period. So you see, this amount, like this one, this is the amount that would have been recognized. This is the amount that so if they cancel this thing over here, then we will recognize these amounts immediately. We will assume that everything has been vested, all right, including, okay, this one is at the vesting date, so that one would have been a right. Though all the amounts before the vesting date would have been recognized, all right. So that is that. Then step two, what you do is that any amount, any payment made up to the fair value of the equity instrument at that cancellation or settlement, you will treat it as a deduction from equity. Okay, we will use an example to also show what I'm saying. But what we are saying is that any payments made, to the fair value of the equity instrument, any payment that has been made to the fair value of the equity instrument at cancellation. You know, when you are canceling it, there's a settlement. So at cancellation, or settlement, because you can't just cancel an agreement like that. You have to suffer for it. Any of such is treated as a deduction from equity. What deduction? What form of equity? Where in the equity will we deduct this thing from? Yes, who can tell me? Is it the stated capital or where?
OC.
All right. Now, the last thing you do is that if the payment was made in excess, then that excess is treated. So this payment that you made, if the payment was in excess of the accelerated amount that you recognize, that excess will be treated in the P&L. All right. So treat excess of fair value of the equity instrument at cancellation or settlement as an expense in the P&L, the statement of profit and loss. All right. So that is what you do at cancellation. So you do an accelerated vesting. So all those amounts that would have been vested, if not for the cancellation, you will bring all of them, you will treat them, you recognize those amounts over the period that would have been recognized over the period. Like doing these things, you recognize them fast. Then any payment made up to the fair value, so equal to that fair value of the OCE, what we are saying is that you treat it as a deduction. All right. So that is that. But if you paid in excess, then it's a form of a penalty you've paid, other than which went to your OCE from this first entry. So it means that it's a form of a penalty that you paid, and as a penalty, it will be treated as an expense. All right. Any question? Because you are going to use the example 5 to illustrate this. All right. The question 5 to illustrate this. Okay. So let's use the question 5 to actually illustrate what we are talking. So we've learned modification, we are learning cancellation. All right. So when they cancel it, what do we do? So that is exactly what we are doing. So we have the next question to guide us understand this demo. All right. So the question here tells us that an entity introduced an equity settled share-based payment scheme on 2010 for its 5 directors. Under the terms of the scheme, the entity will grant 1,000 options to each director if they remain in their employment for the next 3 years. All 5 directors are expected to stay for the full 3 years. The fair value of each option at grant date is 8. On 1,000, oh, okay, so I need to change this date. I need to change this date to 2010. This one has to be 2010. And this one has to also be 2010. All right. So on June 2010, that is halfway, June 30th, halfway, the entity decided that the share-based payment scheme, schemes on profit target, decided to base its share payment scheme on profit target instead, and therefore canceled the existing scheme. On June 2010, 30th June 2010, it paid a compensation of 10 per shares for each of the directors. The fair value of the option on June 2010 was 9. All right. So explain with calculation how cancellation and settlement of the share-based payment scheme should be accounted for the year 2000. This one too should be 2010. I could have just changed this one to 01, then it's shows everything. But 2010, 2010. All right, so that is the question we have on our hands to deal with. Okay. So any person to what we just mentioned, the procedures we just mentioned, any person? Any person. So we are talking about cancellation. So that is what cancellation and settlement. So what we said was that you have to, step one, do accelerated vesting. So you assume that the amount that would have been vested up to the vesting date will be, you will do that immediately. So what that thing means is that you quickly move to, if they will all stay, so this one, they said all of them will stay. All right, so it means that all the 5, so we will have 5 directors. Accelerating, we have 5 directors multiplied by 1,000 options. Please, who can tell me the fair value to use?
8 cedis.
8 cedis. All right, so that is that. So by 8 cedis, we are not going to do any 1 over this, 2 over this over that, this over that, because it happened in the first year now. So we said that accelerate the vesting. Wherever you are, accelerate the vesting. So you are going to accelerate the vesting because the share option has been cancelled. This means that all the expenses that were not charged to the P&L must now be recognized as at the end of the year quickly. All right, we have to recognize all those things. All right, so what is the answer? What answer do we have?
$40,000.
It's 40,000. All right, so that is what we have. All right, now we come back and do what you know. What you know. So we've done the accelerated vesting, the accelerated one. All right. Then so this is the accelerated vesting. So what we go ahead and do is that normally under normal circumstance in our first year, what would you have done? Okay, so we do that, we take it off. If you check the question talked about them making a payment. So here the entity decided to make a payment on the scheme. So it says that on June, the entity decided to make the thing based on the profit targets. It therefore canceled the scheme over here, and it paid a compensation of 10. So we will certainly come to the compensation that was paid. Okay, so first of all, let's take it step by step. All right, so what we do is that under normal circumstance, we will go ahead in our first year. What we would have done is to do our 5 directors, we multiply by our 1,000 options, right? Then we will multiply it by 8. 8. Then by 1 over how many years? 3 years. So 1 over 3. This is our normal expense that we have. But since we accelerated the thing to recognize all the thing that would have been vested during the vesting period. So that is the one that we have done, all of them, because all of them stayed. 5, they all stayed. So that means that at the vesting date, all of them would have vested. So that is why we have 4,000. Then we have our expense. So this one would have been our total expense. This is the total expense calculation that we are trying to do. So that is the total expense calculation that we are trying to do. But please, once we do this, how much are we getting?
$13,333.33.
Yes, so that is what we have. 13,333.3. Let's round it here. Let's round it 0.333. So the expense that we are going to recognize will be the difference. So this one will be what? So here will be 7,667. I have 26.
66.
Yeah, so this will be our expense to be recognized. All right, so that will give us our expense to be recognized. And so therefore we will debit our SPL and credit our SOFP, which is our equity, OCE, sorry. Or let me just say equity OC. All right, so we have 26,667, 26,667. So that is what we've done. All right. But there was a payment that was made.
What based on sister Tazota Chika Mansudu Kabasutiba? No, she for the Tamalieti crack.
All right. So we now come to the payments. We've done the accelerated vesting. So we recognize that amount that would have been recognized over the vesting period. So that is what we did. And we took off the expenses recognized at the year ended, the very first year. The very first year. All right. I think let me. This one was 2010, right?
Yeah.
No. Let me change these things. Well, I think if this one is 2010, it means that it was half in the year. This thing was half in the year. We can't recognize the full thing like that.
Yes, sir, because it's in June.
Yes, it's in June. So if I want us to make it like this, then I need to change the dates. I need to change the dates. So this one will be 2010. This one will be like 2011. Let me change the date. Other than that,
if you change the date, is better.
Yeah, let me change the dates. Other than that, we have to use 6 months for these things. If it is in June. So we are preparing this thing in 2011. That will be. That is why. So what I've done is we have recognized 20. So this one will be for 2010. This one will be for 2010. The very first year. You see the dates that have changed here. Okay, per the dates that have changed here, and at the terms, it means that since the cancellation was done in June 2011, what you see is that the acceleration, the first year would have been done, 2010. Then what you see over here is the second year, which is the 2011, which, because by the end of the 2011, we already know that the thing was canceled. Accounting is done at the end of the year. So we already know that the thing is canceled. So that is why we are canceling it as at that time. Okay, so this thing is something that we've done in 2011, but we are taking away the 2010 one. Please, do you understand? If you don't, let me know, because it's very, very important. This thing is 2010, which means that before we get to the cancellation in 2011, 2010 one that we did, we are taking it off. That is what we've done here, because we are accelerating, because the thing will know it's canceled. So this thing should no longer be there. So if we accelerate the vesting, this is the acceleration of the vesting. So this is the expense that we want to recognize. But we have to take off the last year one, because the last year 2010 one, because the thing is being canceled. It should not be there anymore, but we are treating the accelerated vesting. All right, please. Other than that, if we keep this one at 2010, it means that we will accelerate this one only. We won't treat this part as part of our solution, because it's canceled in the same year. So it would have been just 40,000. We won't have to deduct this one. Please, do you understand my point? Let me hear from you, please.
Thomas, please come again.
Yes. Okay. So let me do the two scenarios for you. This one was 2010, right? I made these things 2010.
Yes.
And this one was what? 20, or this one was like this, 2011.
No, it was 2010.
It was 2010.
Yes.
Okay, 2010. I'm saying that if the question is like this, it means the cancellation was done in half of the year. Please, are you getting it? Okay. Half of the same year they issued the thing. Is that okay?
Yes.
Please, let me hear from you. Let me hear your reactions.
Yes, sir.
If the thing is at this date, it means that when they issued the thing at 2010 January, they canceled it. They said that they canceled it. This is the date they canceled it. So it's just 6 months of the thing they did. So over here, there is no proration anymore. What you do is that step one is what? Accelerate the vesting. The question said that all of them were expected, all 5. So you accelerate, and by accelerating, that is what we did here. So you just do 5 by 1,000 by 8, which gave us 40,000. So that will be all. We won't do any 2010, any back year anymore, because the date, there's no back year. It is the same year they gave the thing, the same year they are canceling the thing. Are you getting it? Hello?
Hi.
Yes, sir.
Hey, I'm not hearing anything from you people. Is it that you don't understand what I'm saying? I need your reaction.
We are with you, sir.
And so so if the question is like this, if it is 2010, 2010, cancellation is done in the same year they gave it. So as at the end, the December 2010, there wouldn't be anything there. All that you have done is that there wouldn't be anything for you to treat, because it has been canceled. So the only thing you do is the step one I gave you was what? Accelerate the vesting, right? So this is the one that you have done. You have accelerated the vesting. When I say accelerate the vesting, what I said was that recognize the amount that would have been recognized over the vesting period. And this is exactly the amount that would have been recognized over the vesting period, 40,000. You won't have to deduct anything. Please, do you understand?
Yes, please.
Yes. So now, so this would have been it. If the question stayed like this, then you move on to the amount that was paid. If now the amount that was paid, so here your acceleration will end you up debiting your SPL and crediting your OCE with 40,000. 40,000. This is what you should have done. Then you come back to the next thing that I said was that any payment made up to the fair value at cancellation is treated as a deduction from what? The equity, which would have been this. So what is the payment? The payment that they paid, what would be the payment? They said that it paid a compensation of what?
10 per option.
Yes, 10 per option for each of the 5 directors. So if it is 10 per option, what will you get? So 10 by 5 by 1,000, right? And that one will give us how much? 50,000. So this is the payment. So any payment up to the fair value, up to the fair value. All right. What did I say? Will be deducted from what? The equity option. So that is that. And the third thing I said was that any excess of the fair value will be treated in what? The what do you call it? The P&L. That is what I said. So you've seen the payment, this payment that has been done. If this is the payment that has been done, what do? You offset this. So you could see that you could see clearly that what has been done here. Look at this. The payment was 10, but the fair value of the option at that same date was what? 9, which means that they paid over by how much? 1. That is what happened. They paid over by 1. So first of all, we said that any payment made up to the fair value of the equity at cancellation what is taken from this account. So that is what you do. You take it from that account. So what do? You take this amount from this. Then you realize that the third thing that I said was that payment made in excess of fair value of equity at the settlement date is treated as what? P&L. What is the fair value? This is the fair value at the settlement at that date, the same date. And so therefore, the difference, which is 10 minus 9, that you have, you multiply it by 1,000 by 5, which will give you 1, so it will give you 5,000. So this 5,000 should go to the P&L. That is all that I'm saying. This 5,000 will go to the P&L. That is the difference that you have there. The 5,000 will go to the P&L. Then you could see that, assuming you have this, you realize that this one, the equity, which, so the same thing, 5 by 10 by 1,000 by 9 would have given us how much? 9,545, which is the 45,000. So this is what they should have paid. Okay, this is what they should have actually paid, but they paid 50,000. So the excess is 5,000. So please watch the language that I give you and let's apply them. So what we are saying is that any excess payment of fair value of the equity instrument at the cancellation or settlement is treated as an expense. So this is the fair value. Payment made in excess of fair value at cancellation. What is the fair value at cancellation? 9. Payment made in excess. This is the payment, 10, that was made. So they paid this. That is the payment. But at the cancellation, it was 9, which is 45. Any payment that has been made in excess over here is what is going to the P&L. That is all that we are saying. So this OCE that is here. So if you want to pass the double entries of this question, so I'll come back to this when I change the dates. I'll come back to this. So any payment that is here, what you realize is that, you see, you have debited expense. So you debited expense of 40,000. You credited OCE of 40,000. Now, payment. What do you do when there is payment? What do you do when there is payment? So
It's a
you
credit account.
credit your cash. Cash will be 50,000. Okay. Then this one. So when you credit cash and you have the corresponding entry, which is what you have here, you debit your P&L with this 5,000. So let's debit P&L with 5,000. Then the last one is this fair value at the cancellation, which is a credit also to your OCE of 45,000. So you see, you can balance the thing now as you have here. So this one is how much? This one is 90,000. Then this one too will be 90,000. That is how you balance up. So the excess, so step one, I said accelerate it. This is what we mean by accelerate. So you accelerate. Accelerate. Then step two, what do you do? Payments made. All payments made up to the fair value at the cancellation date is deducted from equity. This is the payment up to the fair value at the cancellation date. This one, that is the fair value at cancellation date. So you do that. That is what you do. You deduct it from what do you call it? Equity, OCE, and this is it. This is what we've done. You are deducting OCE. Step three, any excess payment is treated as P&L. So the excess. Well, what is the excess? They pay 10,000 instead of paying the 9 at the cancellation, and that the excess is 5,000. So you debit that one to the P&L. So at the end of the day, you could clearly see that the OCE that we have done, you see, you have two debits, which is 45,000. All right. And you have this one, 40,000, that is canceling off this 40,000. Then there is a remaining 5,000 for corresponding this 5,000, the remaining. This is a debit. That one, the remaining 5,000 is the credit. So technically, you are removing this off with this. So 40,000 is taking care of this. Are you seeing it? Then you have 45,000 in your P&L. So this one plus this one, the double debit, then you have what is reducing the 5,000 to. So automatically, this is what you have hanging. All right. So please, that is what you are supposed to do. So if by what I corrected the question will be, that is how it was supposed to be anyway, because I wanted to show you when, let's say, the cancellation is done in year 2. If you are doing the accelerated, when something has already happened back in the year, what will you do? So that is, please, are you okay with this one? So that I'll move to the second scenario for you. So this is a cancellation that is happening in the same year of the issue, the agreement. So you accelerate, then any payment made up to the fair value of the equity instrument at the cancellation date or at cancellation or at settlement is treated as a deduction. That is any payment. So this is what you have there. So this is the payment. The payment is 50,000. Any payment is treated against this one. But of the payment, the excess, but the excess, be careful, it is the excess of the fair value of the equity instrument at the settlement date. This is the excess, this one and this one. So that is what you have. But what I wanted to change, it won't affect this thing. It has nothing to do with this thing. It has everything to do with, you see, if please, are you okay with this? Because I want to change the dates now. I want to change the dates now. Are you okay with this part? Hello?
Yes.
Hello.
If you have questions, let me have them so that we can answer them and move on to what I want to show you. But in the absence of any question, then let me show you what I wanted to show you. Okay, so these ones will be off. So let's now go back to change the dates, which was my intent originally anyway. So this part, I won't clean it because it will be the same. Now, what I want to show you is this. So this is 2010, but the changes happened in 2011. 2011, 2011, 2011. Then we are performing this thing at 2011. So if that is the case at 2011, then it means that when we issue this thing, it will cross up to 31st December. So we will first do this one down. It means we will do this one. So, all right, let's just do it all over. So under normal circumstance, we will be doing this thing for the years, but the requirement is in 2011. But you see, under normal circumstance, you would have gone to do your 2010 financial. That one, you do your normal thing. 5 of them, all of them are expected to be there. So you do 5, then you do 1,000 options, right? Then you multiply it by 8. Grant date, then you do what? 1/3. Is that not what you would have done? And when we do this, you will have OCE and expense. Is that not it? OCE, what was the figure? 26 something, 667, or oh no, 13 something. You gave me 13.
13,333.
This is what you would have done for your first year. Then you will come to the second year, which is 2011. But in 2011, you realize that on this date, the shares, everything was cancelled. It was cancelled. You say it was therefore cancelled, cancelled the scheme. So that is that. It therefore cancelled the scheme on this. So as at the end of the year, this thing will not exist anymore for us. It won't exist.
Yeah.
So it means that we need to do step 1, accelerated vesting, which is 5 over 1,000 options multiplied by 8. Yeah. So accelerated option means that all of them that would have, the number that we think that would have vested at the vesting date, since we will not get to the vesting date, we are assuming that it is vesting now. So that is the step 1 I gave you. Accelerate the vesting, assuming that the vesting date is now. So we won't have to do any 2/3 because it is now. All right. So what? And you gave me 40,000. Is that not it?
Yes.
So it will be 40,000 over here. Here will be how much? It will be 26. You gave me a figure. The thing that we do, yes, expense 26667, right? Yes, that is what I did before when I subtracted that thing for you. I don't know, maybe you
Yes,
got
sir.
confused.
That's like the first one. I didn't bring the 1/3. Oh.
No, the first one I did. I actually did it like this, 40,000, and I did the 1/3 thing, and I did minus 13,333, and I gave you this 6. Yes, that is what I did. This is the same thing that you know. It's just that when I turn it, it looks as if you don't. So okay.
Don't turn it again. Don't turn it.
All right. So that is what we did. So that is the expense. That is the expense. That is what we had. All right. So you see that it's the same thing as we have here. OCE. This is what we have here. Now, we won't continue again because the thing was canceled. All right. So when you hit here, what we are going to do is that then we come to the part. Step 2 said what? All the payments that you have made up to the fair value of the equity instrument at cancellation is treated as a deduction. As a deduction from what? From the equity. All payments made will be treated as a deduction. What is the payment that is being made? The cash payment that is being made is what you do here. So the cash payment, which is how much? 5 for 5 directors, 1,000 options at how much?
9
10.
cities.
No, it's
Okay.
10 payments. It's paid.
Okay.
Yes, at 10. It's how much? You get, it's 50,000. Is that not it?
Yes.
Yes, so that is what I'm saying. So now this 50,000, okay, this 50,000 that you have, it will be taken care of in this one. So I said that it must be treated as a deduction from the OCE. So it will be deducted from this one. So you debit your cash, it's a payment, you credit your cash. The debit, it will be against this credit in this OCE. That is what I'm saying. All right, that is what I'm saying. Then step 3 is that you treat all the excess of the fair value of the equity instrument at the cancellation date as an expense in the, so what is the excess? The excess is the 10 they paid over the 9. This is the fair value at that date, and this is the payment that they are making. So multiply by the same five people by the same 1,000 options. You are going to get 5,000. And this is another extra expense, which will go to your P&L. So that is what we are saying. So you practice these 3 things, you are done, you go your way. That is all about cancellation. All right. Please, any question? Any question? Any question?
No, sir.
All right. So follow the steps. Follow the steps that I've given you. We did, so you see, the cancellation was on the 2nd year. So that is why we landed here. So you have to take away, you have to deduct this one. All right, you have to deduct it. So the 2nd year thing that I did for you is this part.
Hello, sir.
Yes, please.
So if the cancellation was to do it like 3rd year,
the
2nd
so
year will
you
be
do
5
this
times
one,
1,000,
you do this one,
2/3.
So the 2nd year, you do the normal thing you do. This one would have been 2/3.
Okay.
Then the 3rd year, you cancel it. When you cancel it, you see what will happen is that you have to deduct the 2 years back, the 2 years thing that you've done back. So over here, your answer here will change. I don't think it would have been 40. It wouldn't have been 40. Yes. So when you get the 3rd year, then you deduct back They say, so the cancellation will be on the 3rd year. So you have to deduct and get the one that will be sitting in your P&L. All right. So that is that. But even with this OCE, you see the cancellation was done. So it won't accumulate to this one. So this one, it will be the same as the 266. It won't accumulate because it's a cancellation. We ended it. It won't be an accumulation. So that is why I said in the first, with this thing that you get, you will debit your expense SPL and your credit OCE with this 26667 because it won't accumulate. It was cancelled. It won't accumulate. All right. So that is something that you need to do. So when it is cancelled, it is this one that you have here. You debit your SPL, you credit your OCE with this figure. So it is not this one that will go to your OCE anymore. Why? Because it was cancelled. You can't accumulate into it. If it was not cancelled, you accumulate them. If it is cancelled, it is not there for you to accumulate, for you to have a 40 in the OCE. All right. So that is what I'm talking about. All right. So that is that. So that ends up. Yes, please.
What about if the second fair value was not given, the 30th June 2011, the 9 cities?
This one.
Yes, please.
It means that it will be the same value here that will be running through.
10 minus 8.
Yes, 10 minus 8. It means that it will be the same value, fair value that we run into. Just like we did at the modification. I didn't mean like in the modification question, they did not give us the 10. It means that it will be the fair value that from the grant date that will be running through. Okay. So that is that. All right. Any more questions? Yes, please.
Hello, sir.
Yes, please. I'm listening.
Yes, sir.
I'm listening, sir. Or you are making a call. You are not referring to us here.
Daddy, what is your favorite game?
All right. So please, I think, is it Mr. Aigban? I think there's or Ransford is your child. All right. So that is that. That is that. The last thing we are going to do. So I'll look at that, and we will end the share-based payment. So we are done with equity settled share-based payment. Let me run you through the cash settled share-based payments, and you will be good.
No, please.
Hey. Mr. Ransford, I think your call is distracting us. So it makes it look like you are referring to us.
Sir.
Yes, please.
So in case the years like 2010, 11, 12, and 13, and 13 they cancel. That means the figure I'll get from that's what I'll subtract from the cash. Or how will I do it?
Come again.
I feel like if they give you the years like 2010, 2011, 2012, and 2013, they cancel.
So 2010, 2011, 2012, 2013, 4 years.
Yes, please.
Is that what you are saying?
Yes, please.
And they cancel on which time?
Like the 2013.
So 2010, 11, 12, the last year.
Yes, please.
Before you get to the last year, it means you must have done the 3 years analogy first. So you deduct all those 3 years because it has been cancelled. You can't let the 3 years stay in the books.
Okay, so that means you have to cancel from 2010.
Yes, you have. That is exactly what we did here. That is exactly what we did. So you see, when I change the date to 2011 like this, so you see the 2010 would have been done. So that is what we did, the 2010. That is what we did by multiplying the 5 by 1,000 options, multiplied by 8 first. So then we did 1/3 because at this point there is no cancellation. And you gave me the answer to be 13,333. That is what you gave me. So now that so this would have been 2010. Now that we come to 2011, we accelerate. So by accelerating, step 1, when we accelerate, it will be 5 options multiplied by 8. We are vesting it at this time. So I had 40,000. But you see, this, so here would have been 13,000. And for the first year, then we have 16, was it 26, 667 he gave me. But you see, this is cancellation. It means that if you are canceling it, this one should not exist anymore. It shouldn't be there because you were making some provisions up to the vesting date, and the vesting date never come because the thing has been canceled. So you have to remove these things from your books. How do you remove these things from your books? And that is why I did 40,000 minus the 13,333 that you have done before. It can't be there because the thing has been canceled. You have to remove it.
Okay, sir. Then that means I have to add all the 2010 to 2013 and subtract it.
So you are telling me that assuming the question started from 2010, 2011, 2012, 2013. Is that not what you're asking?
Yes, sir.
And the cancellation was done here.
2013, yes.
13 before the vesting date, right?
Yes, please.
So if the vesting date is 31st December and it was cancelled somewhere 30th June or before the vesting date, it means you do this thing. You do this thing we've done for year 1, but it will be 1/4 in 3 because the years are 1, 2, 3, 4. That is what you would have been doing. This one we do with 2/4.
Yes,
this
sir.
one you do with 3/4. But when you get to the middle of this place where you get your OCE line, and because the thing has been cancelled, you need to go back and cancel all these things by deducting it from the OCE figure.
Okay, so by adding all the 3 and deduct it from the 13 figure that
yes,
you get.
exactly. That's exactly the point. And deduct it because it can't be there. That the scheme has been cancelled. And so these things can't be there anymore.
So what about if it was cancelled at the end of the year? No, not 30th June. Maybe.
You can't cancel the thing on the vesting date because on the vesting date they are entitled to it. You can't cancel it at the vesting.
Before that, you can cancel.
Yes, you can only cancel during the vesting period or before the vesting date.
Okay, sir.
Is that okay?
Yes, sir.
Thanks for the question. You have helped the class because people probably wanted to ask. I don't know. Maybe they've turned their attention to. Somebody said the date rush is starting at 8 something. It is 8. So probably they've shifted attention to date rush. All right. So I think we will have one last question to deal with. Then the rest is purely the. Hey, we have 2 questions. And the rest is purely the past questions. All right. So given our time, I think that I will end it here.